Alpha Team, bringing you another video. Today I want to talk about volatility versus risk. It's a common misconception when dealing with clients where volatility gets conflated and lumped in with risk when they're not essentially the same things. Volatility can be a component of risk, but some main differences, right? Volatility is basically the fluctuation in price or value of an asset, right? Where risk is the potential to lose your principal, in simplest of terms, right? Or in our office, we're really focused on goal-based planning, right? We invest according to what those goals are. We rely on the markets to do what they've done historically. That's no guarantee of future results. I'm required to say that, but it's true, right? We have a long track record, and this is what we base a lot of our assumptions and decisions and recommendations on, is history, right? What have the markets done? The stock market is averaged nearly 10% per year. I'm talking about the S&P 500 for nearly 100 years. So when we talk about investing in the stock market, our assumption is over long-term investing that this is an expectation, okay? Volatility, though, completely different, because the stock market can be very volatile. Case in point, my first year in the profession, 2008, was the start of the Great Recession. The stock market dropped by 50%. That's volatility, right? Now, if you use asset allocation and diversification, and you remained invested during that time frame, most clients were fully recovered from that 50% drop in the stock market by the end of 2010, roughly 2011. Okay, if you sold out and locked in those losses, you lost, right? That was risk. Selling at that point was risk because you locked in your loss of principal at that point. Or different investments carry different risks and different volatilities, right? The bond market historically, the U.S. aggregate bond market, volatility-wise, has been very low volatility, right? 2022 being an anomaly of a year, the bond market was down roughly 13%. But dating back to 76, the worst year in the bond market prior to 2022 was negative 2.9%. Part of the price you pay, though, is that the returns from bonds are not nearly as high, at least historically, as the stock market, right? Your price for better returns is withstanding volatility, right? And this is, again, if you're using proper strategies as far as asset allocation, diversification, right? I'm not talking on an individual stock or bond basis because there's much greater risk with that. You buy an individual stock, there is the risk of that stock going bankrupt. That's an actual risk, because then your value can be zero, right? The odds of that happening when you own 100 stocks are very slim, right? For your whole portfolio to go to zero. This is why mutual funds have a spot, ETFs, exchange traded funds, have a spot in investment strategies because they diversify. They're an easy way to do that. An investment with higher volatility can be considered riskier, which is something that we actually communicate with clients, is that when we're investing in more stock-based positions, there will be more volatility. You have to expect that, right? So we are taking on more risk from that standpoint, in the idea that if you had to sell your investments, you could have loss, okay? This is why typically for retired clients or those approaching retirement, we're scaling back the risk of the volatility. This is how they can work together. Please like and share the video. And if you yourself or know of anyone that would like to talk with an advisor like myself, have them reach out to my team. Thanks and have a great day.